Okay, time for another Q&A. First one, for the sell-off waiting to happen, most of these companies are private. No, they're not. So what would be the structure of potential sell-off? Maybe a more concrete question is, for those 500 companies, where are they spending the cash investors gave them? Well, when did they give them cash? Is it on chips? I think I see your confusion. When we talk about sectors, there is a public sector and there is a private sector. And the public sector is government. The private sector is businesses. Businesses can be privately held or publicly traded. So maybe you're getting these two words confused, but publicly traded means you have a company that issues shares on an exchange and they're shareholders. So they are not private, they are publicly traded. Individuals can sell their particular piece of the company. As far as spending cash, when a private company, decides to become a publicly traded company, they have an IPO, that is when the company gets the cash. Beyond that, when shares are traded, it is between investor and investor. All the shares each day that are traded, the company doesn't get any of that. It's just between investors. So they're not really getting that. But they do issue bonds from now and then. Maybe they issue a secondary offering. Where do they spend the money? Usually it is on, if they're raising money, it is for some significant capital expenditure. Sometimes they raise a little more than what they need. They call it for general corporate purposes. That's usually for OPEX. Company by company, to determine who's doing what, you have to go through their statements and look at their CapEx and what they spend CapEx on. For example, Costco spends CapEx on opening new stores, not on buying chips. Costco's not in the business of building AI models. As it's spent on API access to models and cloud infrastructure, that would show up in OPEX. Some companies, well, they all have some kind of cloud security, but no, that's, there are specific companies that do this, and most companies don't. I understand your domestic currency is CAD. Since you frequently trade U.S. stocks, U.S. dollars widely accepted in Costa Rica, why would you say you have significant exposure to the U.S. depreciating? That is an interesting question. I thought about that the other day, and I thought, what do I care? I live a lot of times with just U.S. dollars. I have U.S. dollars in the U.S. in those investments, and that's what they'll always be. And I have U.S. dollars for whatever I have left in Canada, U.S. and Canadian. And Costa Rica, in almost every Latin American country, you don't need the local currency. U.S. dollars gets you everything. So you do have a good point. Sometimes I think it's just I'm anchored to the past, and I think, well, I think better in Canadian dollars because I've thought in Canadian dollars my whole life. So it's hard to make the mental switch, but maybe you have a point. When the Fed moves out of their MBS holdings, would this be a headwind for mortgage REITs? It could be, depending on how they move out. Being that the Fed is slowly being taken over by loyalists, that is the only criteria, is that you are loyal to the king. There may not be the intelligence left in on the committee to understand not to make a market impact when you move out of MBS. So the risk is probably increasing because Trump's the smartest man in the room, always. He'll tell his loyalists what to do, they'll carry it out, and there's no real understanding there. So I would seem to think that without adults in the room at the Fed, you probably would have to think about, well, if they do sell MBS, would they understand not to make a dent in the market? But typically, they would not dislocate a market. They would do it at a pace and in a way, probably using the forward market, that wouldn't dislocate the market. What about effects of Trump admin pushing for the privatization of Fannie Mae, Freddie Mac? would market demand a higher MBS spread once these federal mortgage agencies are privatized, perhaps losing their de facto government guarantee? I don't think they would lose the de facto government guarantee. They are created by an act of government to facilitate more liquidity and ease of access to credit in the mortgage market by holding these mortgages. If banks had to hold them, they'd at some point become capital constrained. And maybe they would limit out at a certain point and say, well, we don't want any more mortgages. Because their mandate is to support a market and not to pursue the maximization of their value, but to support a market. You wouldn't do that unless you said, okay, well, if we do that, I mean, that's kind of public service. We're not going to shoulder all the blame if we have losses. Right? Otherwise, we're going to have to act in our private interest. So that's usually where the government guarantee comes in to say, look, we'll guarantee these, but you must act in the public interest. So I don't know that higher spreads would be the result. Maybe even smaller spreads as they're under private ownership and they become more strategic and maybe even more growth focused. Swiss-based investor, I fully agree with your point of using options to get exposure to Google without having U.S. exposure. Would you not apply the principle when you want to buy TLT? I do. I have synthetics, $100 synthetics for January. The $100 put component of it is more than likely to be put to me. I don't see $100 by January. I don't see $90. I don't see $89 by January. TLT just gets to 88, and it's just this big negative wave of nope, and down it goes. I am disappointed in this one. Now, mind you, it does have a cash flow stream. Both the TLT and U.S. Treasuries I have, I do get paid to wait. The yields are elevated enough. The return is elevated enough, and TLT does have options that are somewhat good, so I can generate more there. So I can risk manage there. So it hasn't been as bad as $100 down to 86. So at least I have that. If you sell puts, sometimes it's put to you. So you take the underlying. The options just don't provide the same kind of premium that you get on Google because the implied volatility is so very low on TLT that if it's at 88 and you say, well, I'm going to sell a 93 put as opposed to putting cash out, you're basically only getting about $5 for that. You're basically getting its intrinsic value. There's not a lot. And you give up the dividend. The dividend is just not in the puts. Like you give it up. So you get no real income from it because the volatility is just not high enough. And then you run the risk of, because there's no time value in there at all, you run the risk of having it put to you because they're American style. They can be put to you at any time. So it doesn't work as well with TLT. Two questions. Given that we now have a signal for interest rate cuts, why aren't we seeing some pickup in price action for asset managers' names? They have significant tailwind with executive order allowing liquidity exits via 401k retail accounts. Well, I haven't looked at any of these off the top of my head. I'm not familiar with the structure of these companies and the structure of their assets. But if you're saying the sector or the sub-industry as a whole is simply not responding, then there's a missing piece of the puzzle. It is not as if we've stumbled across a massive inefficiency. There must be some missing piece of the puzzle that you don't have. And being that I haven't looked, you're going to find it on the asset side of their balance sheet, whatever it is. That's where you'll find it. If their debt is floating rate, the liability side, it should help them. If their debt is longer term fixed rate, it really wouldn't help them very much in terms of cash in, cash out. I doubt if they would have repo debt. So repo debt would most directly help them. on the liability side. But if there's a hiccup between what you think is going to happen and price action in a group that you think, well, shouldn't they be a beneficiary? Then that means you must be missing something, and it's more than likely on the asset side of the balance sheet. Girlfriend and I heading to Costa Rica in late September. Any recommendations on FX coming from CAD heavy portfolio? You can use USD anywhere in any of the countries in Latin America. I think all the way down into South America, the USD is almost a de facto currency. In Panama, it basically is the currency. In Costa Rica, it is equally accepted no matter where you go. If you say, I want my invoice in dollars, they'll give it to you in dollars, and every place gives you the central bank exchange rate. Every place gives it to you, and some places will do better. They'll go in the middle of the spread, especially if you have cash. So all you need are US dollars. Think in US dollars, but be prepared that almost everything down here is about 50% more expensive than you'll find in Canada, right? So if you think in terms of a Diet Coke, you can go into any store, get a Diet Coke for what, $1.89, multiply that by 1.5 if you're down here. And if you're not paying attention, when you buy your Diet Coke, they may charge you for two and give you an invoice in Spanish that you can't read, and you'll be saying, holy geez, $5 for a Diet Coke. Careful when you're down here. Check your bill each and every time. Everywhere you go, check your bill, because you'll have things on there you didn't order. Check your bill. Check your bill. I know you mentioned being light USD exposure, but would like to know how you manage this predicament personally, as we are considering more travel to Costa Rica, South America. Well, you need US dollars for that. We'll also take any restaurant or hiking recommendations from you. Well, I gave you a restaurant recommendation. No matter where you go, check your bill. No matter where you go, check your bill. You will pay for stuff you didn't order at least half the time. At least half the time, especially if you're obviously North American. Speaking English, that down here you're called a gringo, and you will face gringo pricing, which means no matter where you go, your price will be 2, 3, 4 times higher than anybody else. So if you feel like you're being ripped off, you are. I agree with your target on rate cuts of 3 to 4 by May, and then 4 to 6 by October, largely driven by the Orange King once Powell is gone. How can I play this aside from ZQ? Not comfortable using futures. Never use them. Currently do not have the time or brain capacity to learn them. They're super duper simple. Of course, buying Treasury sounds like the obvious choice, but then there's no leverage. Nope. And I'm exposing myself to the USD. You are. With the potential next best buy to buy leaps on ETF of 5 to 7 year Treasuries. Nope. Not leaps. If interest rates are coming down, you will lose on the leaps. Let me see if I can explain that to you. So let's say you have a stock price, and here you are, and you're going out 1 year. Let's say T is 1 year. We sort of are trained to think of this is at the money, but in options, this is not at the money. You have to take the underlying, and you have to figure out what the forward curve looks like. And the leap will be way up here, which means as interest rates come down, here's what happens to the forward curve. So if you are expecting rate cuts, your forward price is going to drop. So you have calls where you benefit up here on this forward price, but the forward price will be coming down as interest rates come down. So even though the underlying may go up, the forward curve will go down, which changes the delta. So this will give you positive delta. This will take it away. It's questionable whether you make any money on that call or not. So I don't know that is the way to go. Not only that, you'll lose the income component of it. ZQ, think of it like a bond. It will mature at 100 if the interest rate goes to 0, because it is 100. 100. Let's get rid of that there. 100 minus R. R is the interest rate you're betting on. So the October ZQ is sitting just below 97. Let's call it 97, which means The market is expecting the federal funds rate to be 3% by next October. It is 4.33% now, so it's expecting 133 basis points of cuts to get to 97. If you had 233 basis points instead of 133 by October, this would be 98. So you're basically buying at 97 and it matures at 98. And it'll go 97.01, 97.02, all the way to 98. Every tick is $41.67. That's as simple as it is. If you don't want that, what you want to do is you want to try to find a U.S. company. Now, you also don't want U.S. exposure. I don't know that you're going to get a non-U.S. security that would be affected by changes in the federal funds rate. You're going to need a U.S. security. But you can take any company where their liabilities are repos or 30-day debt or overnight debt. That is mortgage REITs and banks. Big time, mortgage REITs and banks. And of course, buying treasuries sound like the obvious choice. Okay, I'll read that. Long-time holder of agency Annalie, concerned that lower rates will generally generate early refinancing wave that would damage both book value and distributions. You are going to get you're talking about in terms of the mortgage holders. Okay, so we have to look at two things here: assets, liabilities, and the yield curve. It looks like this right now, and we're going to cut it off here, and these are money market rates, these are capital market rates. Change in money market rates will affect the liabilities of mortgage REITs. But if the capital market curve doesn't change, then mortgage rates will not change. So there won't be any refinancing of mortgages. The capital market curve affects the asset value of banks and mortgage REITs. As the 10-year yield comes down, all the assets they have on their balance sheet increase in price. So as rates fall, their assets increase in price up to a certain point, of course, because as you point out, they could refinance. If we think about the price yield curve for bonds, it is convex, but for mortgage-backed securities, there is convexity as interest rates go down. This is price, this is interest rates. As interest rates drop, the price of bonds increases, but mortgage-backed securities have negative convexity at that point because they could be refinanced. However, by that point, the asset value on their balance sheet would have increased significantly, and their liabilities are primarily repos, so they get, it's basically floating rate, 1 month floating rate. They get the rate cuts all the way down, which help their liability. But unless the capital market curve moves, nothing changes on the asset side, and nothing changes on the prepayment speeds. How do you build and maintain a focused watch list for selling puts on red market days? The ones that I sell puts on generally are within a sub-industry I think will do well and are either number one or number two in their industry. The two biggest ones, maybe even the three depending on what the sub-industry is, but usually the bigger ones. Now they have lower implied volatility, so they tend to have lower premium, but because of that they have less risk of reaching a 20 delta than, let's say, something that has an IV of 45%. And how do you build and maintain it? The actual keyboard work you do. So here is your computer, here is the market, and here is research, right? The actual keyboard work you do that is directed towards the market in a given week might be 5 to 10 minutes a week, really. The rest of the keyboard work you do is dedicated toward research, where you find a particular stock and it goes on your watch list, and you continue to research. You read, you think, you say, well, that's an interesting thing. What sub-industry are those companies in? Then you start to look at the sub-industry, and you start to look up things about it, and you get to know the sub-industry. Then you say, well, what companies are in this sub-industry? What are all of them? Who are the big ones? then you may look at a few of those. You may say, well, this is worth watching, and you would put that on your watch list. So it is not, the direction of attention is not 100% this way. Looking at your computer to access the market and staring at things on the screen and wondering, well, how do I get to know names? Not that way. This is the primary direction that traders and investors are focused on, and every now and then, okay, let me do something here. I understand you already factor in option liquidity. Yep. Underlying value, other fundamentals. How do you practically identify and keep updating such a list? Well, that was answered. Not using Manus AI anymore. There's so many good ones out there. Like, it's just impossible to use them all. Gemini and GPT-5 are my go-tos now. Claude, a distant third. Kimi K2 is great when I get some output that I like from OpenAI or Google, but I think that it could be a little bit more detailed. If I give that output to Kimi K2 and ask for more of the detail, more of the technical details of it, it does great on that stuff. So that I am 100% satisfied with the tools that I have right now. That to use Manus to me seems like, but I already have the things I want to do. I've used Manus. Manus is good, but I already have things that can do these things. And I upgraded this week to AI Ultra. So I have access to Deep Think. And I gave it a prompt that I gave Gemini. Gemini can answer it in 30 seconds. And it's if I had to grade it, I'd give it a B+, A- on the output. Few little things, and some little things it didn't quite understand, but I can finish the job in far less time than if I started from zero. I gave it to Deep Think, and it's you can get rid of the B-. It's A-, maybe an A, slightly better. But it took about 4 minutes to 5 minutes to answer the question. It really, really thought about it, whereas Gemini answered it very quickly and got me, most of the way there. For the incremental amount I got, So I'm going to give it something this weekend that Gemini cannot do, which is answer level 3 structured response questions. Gemini, almost all AIs break down in trying to answer those. So I'll see if Deep Think can do it. Maybe in doing the things that Gemini can do, you don't expect much more of Deep Think. Maybe it's there for, well, what are the things that you can't get done that you say, well, they're not there yet? Give that a try. I didn't give that a try yet, so that's next. Even with potential benefits from rate cuts in AI, if the market enters correction, wouldn't IWM still be prone to an even steeper decline due to broad-based sell-off, effectively making it an even riskier investment? Look, you're going to take on risk no matter what you do. And if there's a sell-off, everything's going on. Everything's going down no matter what you do. But you have a portfolio, and you think in your portfolio. Everyone thinks this way. They say, I have assets in my portfolio, and those assets will provide a return. So anything that's a risk to my return, I don't really like it. Well, then get T-bills, right? You must take on risk to get any return greater than a risk-free rate. The risk-free rate being what you can get across the yield curve. You do not have a portfolio of assets. You have a portfolio of risk exposures. And your job is not to watch the return, but to watch your risk levels. So you're not managing assets, you're managing risk exposures. You must accept risk exposures to get the return. So it's not about where does all the risk lie? And oh my God, look at it. It's about knowing what risk you're taking on and knowing how to manage it. Yes, if there's a sell-off, everything will suffer. Some will suffer less than others. But if there is no sell-off and you're in those assets that wouldn't suffer much in a sell-off, they also wouldn't benefit much on an upswing, right? It's not a question of eliminating risk in your portfolio. It is a question of accepting risk into your portfolio, only those risks that you want, knowing what the risks are, Asking yourself, am I getting paid to take on these risks? And managing those risks. Understanding, of course, the word risk. Risk means they can go up and they can go down. That is risk. And then you just decide what risk exposures you want, not what assets you want, but what risk exposures you want. And then you are a risk manager. You start thinking, I have assets and I'm an asset manager looking for return. Return will be what return will be. There's not a lot you can do. Once you have exposure to a particular name, you buy Google. The return you get on Google will be the return you get. That's out of your control. That's the market. You know, you can guess or predict where you think it'll go. You might be better at stock picking than others, but once you pick a stock, the return is largely out of your hands. It will be what it will be. But risk management is what's left in your hands. You do not have a stock that will give you a return. You have a risk exposure, and you need to understand the risk and manage that risk. I have a fair bit of U.S. cash in my RSP account. 3.9 in TD's ISA account. I've been using it these days to buy low beta Canadian dividend stocks trading on NYSE, such as BMOTD. Do you see a better strategy? Well, if you're Canadian, your big risk is, because it's in your RSP, your big risk is a change in the US dollar. So ask yourself, we're at 137, 138. What if we went back to 120? Could you live with that? Right? If you had a 15% weakening of the US against the Canadian, that would mean that the US dollar value of your holdings would drop 15% in Canadian dollar terms. And if the assets rise 15%, you make nothing. You would break even. Can you live with a 15% drawdown in the currency? If you can't, that's your biggest risk is the currency exposure you have. Where can I watch Palo Alto Vol Trade Seminar? We did that here in Costa Rica. That is what we do on site here. How to be notified of any upcoming similar seminar. Well, yeah, they're not. I don't do them online or live. Within the applied asset management, you have options and you have portfolio management. And I do cover volatility and I do cover momentum in there. But when you come down here, we have anywhere from 3 to 5 days, depending, on how much of the country you want to see during the week that you're here, but minimum 3 days of markets where we look at different trade setups for momentum, 3 different types of momentum, and volatility. And we look at 3 different approaches to volatility. There's literally dozens of different vol trades out there, but we look at where we would find vol and how we would set up for vol, where we would find momentum, how we identify the type of momentum we have, which dictates the way we would trade that. Palo Alto was earnings, so this was about figuring out what its implied move was and determining, and the front expiries are going to have super high IV. So this was a vol crush trade, but it's the stuff we do down here. Would you be adding to agency and Annaly? I will. With respect to Google search business, if agentic AI picks up, then it is essentially your computer making the Google search instead of you. This is true. Similar to the Apple payment, Google could not make one to Perplexity enter OpenAI to have Google as the default search engine in that remote desktop, and they could maintain their moat in search. I don't see them doing that. I see them creating their own AI browser. I think they have a feature in Chrome, but they lose Chrome, they lose that. But if they lose Chrome, it just could be, we'll have the we'll do our own AI search. I don't know, honestly. It's not our business to solve that problem. It's our business as investors to be aware that that problem exists and look to management for their solution. They are a lot more knowledgeable and smarter than us when it comes to what needs to be done. So we use the good management backstop and we say, well, these are strategic and operational issues. They're not financial issues. We as investors are aware of the risk, the operational and the strategic risk that Google faces in this situation, and we don't have to solve it. We just have to be aware of them and ask ourselves, does management know they have a problem? Now, if Google says we have no problem in search, everything is fine, URL search is not going away, then you would say, well, management is really boneheaded. They can't see the writing on the wall. Then you'd think I should get out because they're not going to fix the problem because they don't have a problem. But management does recognize that they have a problem, so we use the good management backstop and say they're on it. I would like to push back on your argument that LLMs are not intelligent. The unreleased LLM models by OpenAI have been able to achieve an IMO gold and beat all but one developer in a competitive coding. But that's all rules-based, which in itself is glimpses of super intelligence. No, it's not. An LLM will beat you at Trivial Pursuit. Hands down, an LLM should not get any of those questions wrong. It will beat you at Trivial Pursuit. But it's executing code, and that is just declarative knowledge. As far as beating you at Trivial Pursuit, just a Google search can beat you at Trivial Pursuit. Somebody with a laptop with Google search playing Trivial Pursuit with you just answering on your own knowledge, they will beat you. Would you say that that laptop and the Google search has intelligence? Because it can beat you. You wouldn't say that. That's just declarative knowledge. A library would beat you at Trivial Pursuit because if you go into a library, it has all the answers for Trivial Pursuit, but you don't. There's some things you just don't know, but it's in the library. Would you say the library is intelligent? So when we think about intelligence, there are different hierarchies of cognitive domain. Declarative, above that is conceptual, and then you have application. Software's been doing this stuff for a long time. Things that are routine cognitive, software's been doing for a long time. You know, you wouldn't say that Excel is intelligent. It is only useful when an intelligent person uses it. So just because it can pass specific tests that might require declarative, conceptual, or application levels of knowledge does not make it intelligent. What makes it intelligent is if you can reflect upon your own thinking. Not just follow a set of instructions about how to think, but reflect back upon it. So to give you the difference, if you put your hand on a hot stove, you only need to do that once in your life, and you'll have figured it out. An LLM needs to do it 1,000,000 times because it must form a pattern. They won't figure it out. It must be in the pattern. If it's not in the pattern, they're not going to know it. Once is not enough. They're not. So it just could come down to our level of intelligence. So you may say, this output is impressive. It must be super intelligence. But just because something's impressive doesn't mean it's intelligent. I bought the really high-end Sony TV. I mean, it's wicked when you look at it. If you were sitting in my living room in just the right spot with the speakers and the TV, you'd say, this is impressive. Look at this. This TV must have super intelligence. I'm impressed with the output. So impressive output doesn't mean it's intelligent output. I've been personally using it for coding and come up with design ideas and refactor code base that I would have a way hard time myself. Well, because you probably don't have the library of declarative knowledge that it has. Again, I would have a hard time beating a 5-year-old sitting in front of a computer with Google at Trivial Pursuit. The 5-year-old would answer every question. If they know how to type a question into a Google search, they would get every single answer. I would not attribute the intelligence to the child, nor would I attribute the intelligence to the computer. It's not intelligent. It's just a set of instructions encapsulated in hardware, and the Google search is just a set of instructions. There is no intelligence there, but there is a vast database of declarative knowledge, and the only skill the child has is in accessing that database of declarative knowledge. That doesn't make it intelligent. It just means it has a whole bunch more declarative knowledge than I have. That's all. So I don't know that I would say that it meets the definition of the word intelligence. It has no metacognitive skills, and for intelligence you need metacognitive skills. It lacks that. As far as REITs go, how are you feeling about ABR? As rates come down, once I see those rates come down, I feel better about it, sure. A little guidance around whether or not I should invest the time to get CFA. Early 40s, well-progressed career in software. Don't have specific career goals that a CFA would help me with, but I'm genuinely interested in the topics it covers. Intellectual curiosity is a good enough reason to go through the process. I mean, I could just read up on the topics myself outside of CFA. Also, in relation to the hour requirements, do you have any ideas of how to approach this for someone who's already in an established career and doesn't want to go into an internship or whatever people normally do? Then don't do it. If your goal is just the knowledge, doing it, paying for it, for the certification of it is a market signal. We would want some certification that some external body says, hey, this guy over here knows this stuff to this level, that we have given them this degree, these 3 letters, whatever the case is. That is a signal to the market. If you're just learning something for yourself, you don't need market signals. Because you don't plan on changing your job. What would be the point? Right? So let's say that I wanted to learn a little bit more about history. I could always go do a history degree, but I would be getting the degree to signal to the marketplace that I know this, that they would look at that degree and they would know that I know this stuff, or that I've been educated in this field. That's important if I'm trying to get a job in the field, and I need to demonstrate that I'm qualified, not based on me saying, oh yeah, I know this shit, but based on somebody else saying, hey, they passed a whole bunch of tests, they met our requirements, here you go. If you don't need to signal to the marketplace that you know this stuff, if you're doing it for yourself, you don't need the formal route. Understand this might be a sensitive matter. Please feel free to decline if it's confidential. Just curious, when you sold your CFA business, did the commitment to maintain free access to 2018 archive through 2028 have any impact on the final selling price? Not really. I didn't make it a condition. I explained that, it's out of date. For the most part, you wouldn't use it to prepare for a 2023, 2024, 2025 exam. But for somebody who was CFA curious, saying, well, what's this all about? Well, put up the free stuff. It's out of date. It's of no value, really. It does have maybe a 60% overlap. You just don't know where. So as far as figuring out, well, what's it about? It's great to figure out, well, what is the rigor that is required? And for those who are just not interested in pursuing the CFA, you don't need 2026 material. 2018 is good enough. If you just want to learn about markets at a level 1 standard, to know what level 1 candidates know, there you go. But no, it wasn't a requirement that I will not sell it to you unless you leave it there for free. Can we consider rising margin debit balance an indicator of market sentiment? These things, I don't like these things, these kind of charts, because it ignores the asset side, right? It has to be normalized. So if I say, there's a company that had 5 million in debt, then it had 50 million in debt, now it has 500 million in debt, you would say, whoa, that's unsustainable. But here it had 10 million in assets, here it has 200 million in assets, here it has 10 billion in assets. So when you look at debt to assets, 5 million of 10, that's 50%. 50 to 200, that's only 25%. And 500 to 10 billion is only 5%. You'd say 5% debt is nothing. 50% debt's a lot. But look at what happened here. So you have to, if margin debt is going up, $1 trillion, but market caps have gone up like this, you have to look at it in terms of how much margin debt you have versus the market cap of the market. That's the better test. This is just telling you how much you have. Overlay a chart of the S&P on that, and you'll see the S&P has the exact same pattern up and to the right. So this is sort of just meaningless data to me. Is the market ignoring second order effects when throwing a party? As Jay Powell signaled a more dovish Fed. I mean, the Fed communicating the start of cutting phase can slow the economy even more. I don't know how. As companies at the aggregate level will wait until the phase is complete to increase borrowing and refinance projects. Companies make decisions based on the level of demand and competitive necessity. They don't just sit back and say, we shouldn't invest in a new plant until interest rates are lower. What they will do is they will do what they do to meet the market where it is and do what's necessary to compete and use financial instruments to engineer the interest rate they want by using swaps, by using different combinations of debt. But no, they would not wait and be passive recipients of a lower interest rate. They would do what they do when they do it because the market is there or because they have to for competitive reasons. And then they would use their finance team to say, okay, you need to use different securities to engineer the outcome we want. So no, I don't think that it would slow down growth because they would be waiting. Appreciate if I can have your insight on this. Does the price of BTC have anything to do with the strength or weakness of the US dollar? Not really. Well, I shouldn't say that. Anything denominated in US dollars will be affected by the strength or weakness of the US. But I think that BTC's volatility far outweighs the changes in the dollar. But if you see the dollar weakening by 1% and Bitcoin strengthening by 1%, what you're seeing is the US dollar price of Bitcoin strengthening by 1%. So if you think that Bitcoin has a certain value and you see its US dollar value change, some of that may be because the US dollar is changing if you think that Bitcoin should be, one price. Couldn't wrap my head around since my mind BTC or any cryptos are neither commodities nor currencies. Google reveals Gemini energy costs. One Gemini text query, 9 seconds of watching TV, 5 drops of water. A Gemini text query uses 0.24 watts of electricity. It excludes model training. The other thing you have to think about here is usage, right? So Google search, I used it, but AI search, I use it a hell of a lot more. Gemini, I use it a hell of a lot more than I ever used Google search. So maybe one of these is more efficient than one of these, but I use way more of these than I ever of these. So if anything, my water and energy intensiveness has gone up considerably. Even though each unit of it is more efficient, I use way more of it than I ever did before. You mentioned a few weeks ago you're looking to getting into HG and that you will know the entry when you see it. Have you pulled the trigger? No. If you get a close below 440, I think you can run down to 420. Once we get in the 420 area, I will start to get interested in HG, but there's a lot of inventory to work off in the U.S. Regarding the administration strategy to pressure the Fed to lower rates at the front end and manage debt issuance towards bills to drive down the long end, are there any technicalities that could derail the plan? Sure. Sure. I think that was a yes or no question. Yes, there are. Can we say brokerage stocks, IB, are cyclically neutral? No, your trading activity is a function of volatility. If you do have a sell-off and you go into a low vol regime after that, usually commissions and trading activity tend to be very low. But we haven't had that. We've had nothing but V's. Given that they make money when there's a massive sell-off via commission and via cash rate on margin, well, it's a bull. Would you consider IB in your portfolio? Yeah, I would. Question about the velocity of money, which you've already made a video on a while ago. Can we say that if some firms bring their manufacturing to the U.S. and then with them new favorability of skill work degrees, don't know what that means, these conditions can result in an increase of velocity of money? I don't see how or why. As I remember you mentioned, this metric has been trending down for the past decade. So if turning point is observable and measurable, how do you think the outcome will influence monetary policy? You'd have to explain to me how that would change the velocity. It might leave more US dollars in the US, but the speed at which those US dollars change hands, I don't know that building another factory changes the speed at which dollars change hands. You'd have to explain to me what the mechanism would be that would make that happen. What do you think of quitting TLT and getting on a high duration principal strip bond? I've done that before, and I am close to doing it again because I am really getting tired of it. It would be a nice way to get the same exposure and take the upside while TLT is taking a beating. That's true. You'd get about 100 basis points better yield, but you give up the options. And that security you buy, that strip, that zero coupon bond, will mature to par over time. There is no debate about that. It will, and you'll get the same duration exposure as TLT. Now you can get a higher duration exposure, knowing that this will mature to par over time. Period. What do you think? Why do you think the market hasn't responded much to Cook firing? Well, when something goes on for a long period of time, you normalize it, and it just becomes background noise. Trump's moves, it is a slow-moving dictatorship. I mean, he is, if you look at a dictator in a country and you look at Trump and what he's doing, there's less and less daylight between him and a dictator almost every day. That the market has now gotten to the point of saying, eh. But I've said this about the American market before. All you need for the markets to go up is a whisper of a glimmer of hope on the horizon. That's all you need, and the market will go up. But a threat that's across the street, somebody will deal with that. That won't happen. It's not going to be as bad as what you think it is. It's going to be okay. The threat starts crossing the street to your house. You think, somebody will stop it. He's not going to come into the yard. I mean, it's not going to be, we're all making a big deal out of nothing here. The threat is on your doorstep. Well, he's not going to knock. He's not coming in. Somebody will stop him, and we're making a big... Not until the threat is in your house beating the crap out of you do you realize, how come we didn't see this coming? That is the American market. Just last to price in the threat, first to price in the hope. So why is the market not responding to what Trump is doing when he is fully in place as a dictator? And people wake up and say, whoa, what happened here? How come we didn't see this coming? You did. You did see it coming. We have a German fellow here at the house, and he used Mein Kampf as an analogy. He said, the Mein Kampf he wrote 20 years before he did everything he did was his blueprint. He says, if you read it, you'll see that there it was, right there. So in the end, when people say, how come we didn't see this coming? His answer is, but you did. He told you in plain German. He told you what he was going to do, and he did do it. We know that Trump is itching to be a dictator. He wants to be a dictator. He does not want a court or Congress that is not completely under his control. He wants loyalists to him, not the Constitution, and he's slowly doing that. But the U.S. market will not respond until they say, holy shit, they're kicking down our door now. And then they'll respond and say, how come we didn't see this coming? Nobody saw this coming, right? On portfolio management, you said that you have a rule of thumb to start risk management when the position is down 20%. Yeah. Do you have a framework or timeline for a position that's just flat over an extended period of time with an unchanged underlying thesis? Yeah, that's a tough one. I've been in those before. ABR was one of those. We go back to 2012, 2013, 2014. It was just $6 to $7. Every earnings was an increase in earnings. They were increasing their dividend over that period of time and going nowhere, getting no respect. So I know what that feels like. But I was getting paid to wait. So I guess I would say to you, are you getting paid to wait? Are there options that you can use that help you get paid to wait? If there isn't, that money could be earning at least 4.33% a year in the risk-free rate. Anything you're earning above 4.33% in this stock is called an excess return. So when I say, are you getting paid to wait, is your excess return compensating you for the risk of having this exposure in your portfolio? What percentage of your overall investments do you actively manage? 20%. Regarding the decline in the Fed's balance, I'm trying to find a better interpretation. Does it mean institutions now willing to move their money out of the Fed? It means that they have more options in money market securities that they don't necessarily need the Fed. Money market fund gets a whole bunch of money in, and they can't deploy that money because the securities don't exist. There aren't enough repo opportunities in the market. They risk sitting on cash overnight, so they, rather than bid up the price of money market securities, because the Fed is targeting 4.25 to 4.5. So if there's a bunch of extra money, they're going to have to bid up whatever's remaining, and that would push the yield down below 4.25. So the Fed says, if that's what you have to do, you can always come and see us at 4.25. So a money market fund has no motivation to drive a price of a security higher such that its yield is below 4.25 because it can go to the Fed. But if you have a growing pool of money market securities, then there's less and less need for the money market fund to go to the Fed because they might be able to get 4.3 in the market that's obviously without changing prices. Do you have any thoughts on Trump's attack on Bolton? Trump will attack anybody and everybody, period, unless you're singing his praises and showing loyalty and maybe even going to prison for him. But if you're critical of him to any degree, he will use his Treasury Department, he will use his FBI, he will use his courts, he will use his SEC to attack you. And they went on about Biden and lawfare. This is lawfare cubed, right? This is lawfare cubed. The hypocrisy. But look, hypocrisy. All politicians are hypocrites. Oh my God, can you believe what the other side did? And then when it's their turn, they do it twice as hard. And when the other side says, can you believe what they did? They say, oh, listen to them complaining. They didn't take any action to do it. Blah, 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 blah. It's a bunch of dirty people playing a really dirty game that if it benefits us in any way, we're lucky. But it typically just benefits them. I'm studying the applied level, starting the Q-Bank questions, which I think as time passes are becoming better and better. I'd like to specialize myself for utilities. I'll watch the video sector utilities and 2 Q-Bank questions from utility sector. My score is 67 from utilities. Average score for the rest of the folks 74, which means that my score is 7% below the average. Tell me how to improve the knowledge of utilities. All the questions in the question bank require analysis and evaluation. There are no trivia questions. You are not going to get a question where you just know a fact and say, oh, it's this. A utility manages pipes and desalination plants. They're most likely a natural gas utility, electric utility, water utility. Well, clearly they're water, right? You'll find no questions like that. If you want trivia questions, create a bunch of flashcards and you have them. They're all at a higher level of analysis and evaluation. So if you're finding that you're having some challenge up there, you might have to spend some time developing your analysis and evaluation skills, which is something typically that you get done at university, certainly in graduate school. You can be very knowledgeable in utilities. That means if I gave a declarative test to everybody and people scored 100%, you could score 100%. If I gave a conceptual exam to everybody, maybe some people, the crowd scores 96%, but you score 94, because I've gone to a higher cognitive domain. I can get to application, and your score may change. So what you can get at the declarative level is not necessarily what you can get at the conceptual, the application, or the metacognitive level either. Maybe you just need to see it a little bit better, spend a little bit more time with it. But as you go through the questions, read the answers, and especially for the ones that are wrong as well. I put a lot of learning into the question. So the question bank is what are called formative assessments. They help form your knowledge. These are not test questions, they're exercises. Exercises to help build your knowledge, so the questions themselves are learning tools, not just testing tools. I'm DCAing $300 in the SPY every month. If I were to diversify by allocating $100 each to SPY, IWM, CPR, given my time horizon, it will be a good strategy, or should I stick with the current contribution plan? I see nothing wrong with diversification. No, I see nothing wrong with diversification, although I don't know that I'd put 33% into CPER. If you're going to do something, do 150 SPY, 100 IWM, 50 CPER, knowing that you can hold SPY for 20 years, but you're not going to hold CPER for 20 years. That is a risk exposure that probably has maybe a good 5 or 6 year life before it hits a price at which the market can clear. Where'd we leave off? I'm upstairs in my room doing this right now, and I can hear my guests downstairs getting ready for the market. We're 8:04 down here. I got to finish up soon. Last question, the second last question. GDP. Second look at our GDP at 8:30. Enlighten me on this. In the context of cognitive domain emulators, I do not see any barrier but the security and privacy seems to be the biggest explaining factors of why the pace of AI domain emulators are not sufficiently appreciated by the private sector companies. I agree with that. I agree that it is a concern about their data. I'm with you there. Is it not that companies and other private institutions do not value or understand the capability of domain emulators, but they just cannot seem to be affording the potential price of security or privacy breach, even though there can be enterprise protection premises? Well, I think there's a difference between saying we're going to use AI versus an employee can use AI. There are ways to use it without any identifying information whatsoever that can make your employees individually more productive, but to hit productivity at the corporate level might be some time yet. I think that's a big deal, yes. Financial institution with 500 B assets, 500 billion. I would be too hesitant for now to assume the wide usage of domain emulators with potential privacy breach in mind. I agree. Any takes on U.S. sovereign wealth fund early talks on investment in Lockheed Martin? They're not going to make investments. They're going to steal, demand, bribe, and threaten their way to shareholding. They're going to say, you know what? We give you a lot of contracts. What have you given us? We really should have shares. You should just give us shares. The sovereign wealth fund is just going to extract. Now that's a tax on investors. That's a tax on pension funds that hold it. It's a tax on anything. But you got tax cuts in the big beautiful bill. These tax hikes that you're seeing, you're not calling them tax hikes anymore. Oh, we're going to make you guys rich by having shares. And you think, oh, it's just extra stuff. Money's just showing up out of nowhere. No, it's not. It's all yours. It's all your money. Tariffs is all yours. It's all your money. All of that belongs to you, and it is a tax. And that at the end of his term, with all of these things he's doing, if you add all of this stuff up, he could just be the president that oversaw the highest tax regime in the U.S. ever. Because these are taxes. These are all taxes on you. That's how a government gets money. You could say, well, the government's getting richer. How does a government get richer? Off of you. You are going to pay for everything, which is the truth of things. Every penny a government spends must come from you somewhere. So I'll give you low taxes with this hand, then I'll give you high tariffs and shareholder extractments with the other hand. And tell you that other people are paying for it, and hopefully, like 1984, when I give you a smaller portion, but tell you got a bigger portion, you'll say, Big Brother really cares about us, doesn't he?